Welcome back to the Value Investors Club. I'm your host, Timon Wunderlich. Let's get right into it with VIC readings. This is not advice. Let's get started with FXI. FXIHLD 12.25% secured not by Todd 1123. October 21st, 2022. The price at that time was $83. Market cap 1.2 million. Description: FXIHLD's 12.25% note is an asymmetric risk reward with limited downside. First dollar secured risk, and the note is attached from roughly 0 to 40% loan to value. Pays a 50% cash on cash at a current low 80s prices, down 30 points year to date, and has a 40% return profile to a likely 12 to 18 months play. 106 call protection through end of 2023, as think the asset is very likely going to be sold, monetized by the two private equity sponsors, One Rock and Bain. Just a matter of when, not if. Creating the biz through the 12.25% note closer to 1 billion versus a very likely price tag on sale on 2.5 billion. See below. Lastly, the two sponsors have been invested in the biz since 2016-2017. One Rock bought FXI in 2017. Bain bought Innosor in 2016. So it's likely a go time for them to monetize. Take the victory leap, IMHO. Question is if there's a strategic wants to play. Ultimately, like the heads and win tails, I win. See below. Base case 40%, above 40% return, down case 10% return, and one of the higher conviction top of structure trades right now, given 40% LTV, 15% cash on hand. The high probability event that bridges an equity like above 40% return. Analog for this biz reminds me of Plygam many years ago. Market was skeptical, but the resilience of the biz model was overlooked, and the market additionally ignored the strategic interest in the asset. Supplies to PGEM, similar FXI, benefit from the vertical integration as likely results in above 75 to 100 million of savings on day one. Having the strategic angle is helpful in framing the V limited downside risk to first dollar risk already trading in the low 80s, with close to 20% year to month upshot, less of a risk on half year beta. Market view. Market has a negative old school perception of legacy Formex and views it as a cyclical, especially as it is largely tied to mattress volumes. My view in return, market misses the fact that the industry has significantly improved over the past 15 years. What was once a 8+ player industry less than 6 years ago is now essentially a rational 3-player oligopoly. FXI, Carpenter, and LEG, which paid low teens EBITDA multiple for elite comfort. Additionally, market has old school perception of FXI as auto exposed, as it previously had 40% of its biz tied to foam into auto seating. My view, given the acquisition of Innosor a couple years back, majority of the biz is mattress, 70% plus, and furniture 20%, with engineering solutions auto at less than 10%. Lastly, market misses the fact that FXI largely serves a relatively stable and end markets as it agnostic and on how it gets to customer, equals i.e. e-commerce, private label retail, bed and box, and brick mortar. And lastly, foam is a market share gainer in mattress industry as it will continue to take share from traditional inner spring. This tailwind benefits FXI as well as its two competitors. Ultimately, given the rational oligopoly structure, FXI should sustainably generate 15 to 20x percent EBITDA margins, likely more toward the upper end. And given limited capex needs, less than 25 million per annum, the unlevered margins should approach 50% margin. Why the opportunity? As high yield has sold off, anything that has whiff of cycle risk has traded off. The FXI 12% 12.25% notes have traded down from 112 start of year to low 80s current, over 30 points drop. At 18% year to month on the 12.25% note, no longer as exposed to half year beta on HY beta IMHO. This is less about rate risk and more about fundamentals, as well as the market serving up as something based on the SD around the issue. Divergence. Market overreacted to first half year 2022 results, which were negatively impacted by mattress volume slowdown. TBD on when the recovery occurs. And more importantly, margin squeeze is there a 3 to 6 month lag on large portion of biz and passing through output pricing with input inflation. Given these negative headwinds, FXI generated 11% EBITDA margins in the first half year 2022E. Looking forward, inputs are starting to fall off given global demand. FXI is ahead of pricing, particularly on its retail customers, and margins will likely expand to 16% plus in the second half year of 2023E. My guesstimate is that the biz will generate closer to 270 million plus of EBITDA in 2023E, even absent a recovery in mattress units. Though I think the pent up demand from mattress will ultimately be a net benefit at some point, be it 2024E onwards. At the current prices, creating FXI for less than 3.8x 2023 EBITDA, and given the minimal capital expenditures, equates to less than 4.25x EBITDA capex. LTV coverage. Rumor and market that sponsors pursuing a sale of FXI. While the cycle risk over past few months might have nurtured timing of this, but don't think changes the course. My guess is that the biz likely generates real strategic interest, and particularly from manufacturers of the input, TDI, MDI, polyol, as tremendous benefits to vertical integration and or interest from players such as LEG that bought Elite Comfort for 13x plus EBITDA in 2018, i.e. $1.25 billion PP for 600 to 620 million of revenues. Compare that to FXI that generates closer to 3x the revenue as Elite Comfort. Don't think it's a stretch to assume One Rock and Bain might be sitting on a 2.5 to 3.0 billion TEV biz versus 1 billion created through the 12.25% at current prices. I ultimately think we get clarity on a sale process over the next 12 to 18 months, and 12.25% notes will prove out to be less than 50% LTV coverage. Financials. Quick snapshots of the financials below. My 2018 to 2020 figures give 50% partial credit to Innisar synergies. The company ultimately exceeded their synergy targets, and the figures in 2021 onwards don't give any further credit. My guesstimates on 2022E and 2023E below FWIW. So he sees revenue in 2023 E at 1.6 to 1,620 million, and capex to go to 25. Capital structure. V straightforward, two top structure securities. First, 505 million of 7.875% due end of 2024, and two, And second, 12.25% due end of 2026. My view is that both securities come out together likely in a sale, and the 12.25% are the superior trade given coupon plus call protection. I'm sorry. Capital structure. Base case. As the market grows increasingly comfortable and the margin profile recovery of the BIS back to 15 to 20% and better understands the glide path for 2023 i.e., above $250 million, even in current recessionary environment, the notes should trade healthier given the 50% cash on cash pay. Ultimately, think the two sponsors pull the ripcord and sell the assets at some point in 2023. If not, they need to refinance the late 2024 maturing notes, and I think they do a holistic refinancing. But sale is the most likely play. Getting 12.25 points of coupon over the next 12 months and above 22 points of OID to 106 call protection equals more than 34 to 35 points on 83 to 84 entry of above 40%. Downside case. Cycle is nasty, i.e., GFC volumes continue to fall off hard, but margins should win as inputs are falling. Strong evidence of this already. Let's assume revenue falls off by minus 20%, but margins expand closer to 18 to 19. Still implies something close to 240 to 250 million of EBITDA. Let's assume margins go haywire as well and compress to 14%, still likely in the 200 million EBITDA context. Even at these lower levels, BIS is generating a 40 plus dollars of free cash flow, 14% margins, and $90 million plus of free cash flow, 18 to 90% margins. Maybe the market requires a better than 18% year to month on the 12.25%, i.e., let's assume spreads gap out another 200 basis points for HY and FXI gets taken down alongside. That implies a 79 px on the note or down minus 4 points give and take. Getting 12.25 points of coupon along the way, offset by minus 4 points of price, still gets 8.25 points on 83 to 84 entry or 10% return profile. Most importantly, the setup at 79 20% year to month is even more attractive and allows to play for bigger outcomes. Disclaimer: intended for information purposes only, not investment advice, and should not be relied upon as a basis for investment. Author holds a position in the issuer and undertakes no obligation to update any further future changes in the position or in the investment opinions expressed herein. FXI bond portal access provided by FXI. Probably best reach out to CSTACY at FXI.com. Catalyst, second half 2022 margins, 2023 commentary, glide path, updates on any strategic process, 2016-2017 vintage LBOs by One Rock and Bain. Thank you very much for tuning in. See you next time.